Hey everyone, Tesla has gotten quite a number of price target upgrades over the past few weeks, and I thought it would be fun to take a look at them. In particular, I saw 7 price upgrades, as you can see them from the January of 6th all the way to January 20th in the year of 2021. So let's start from the earliest one. On January 6th, from Morgan Stanley, they upgraded their price from 540 to 810, and that's a 50% increase. So let's take a quick look on what Morgan Stanley had to say about this price increase. Essentially, they said Tesla is still the best positioned company in EVs and AVs under our coverage because of its people, the technology, the business model, and access to capital. Plus, they have no entanglement with environmental liabilities, which its legacy competition is burdened with. So put it all together, they believe that Tesla's business model can unlock recurring mobility services revenue even faster and more profitably than its competitors. While at the same time, the article mentions Barclays price target of $230, but we're not going to get into that. But essentially, Morgan Stanley believes that Tesla is in a huge lead, and they are poised to gain even more recurring revenue before all the other automakers does. Here's the second price upgrade. It was from RBC. They raised their price from 339 to 700, which is a 106% increase. So far, this target has already been hit when it was first announced on Jan 7th. So let me just quickly compare with the graph. So January 6th and January 7th, that was when Tesla was hovering around 750 to 800-ish. And well, the first two target prices has already been crushed. Let's see what RBC has to say. Tesla call was completely wrong, says RBC after a 1,200% rally. There is just no graceful way to put this, other than to say we got Tesla stock completely wrong, said Joseph Spack during a report lifting Tesla to perform. They have been rating Tesla as underperformed for the past 2 years, and within the last 2 years Tesla has already went up by 12 times. But his key point was they underestimated Tesla's ability to take advantage of its stock price to raise capital and even fund growth or even more acquisitions. Well, that's an interesting perspective, because Tesla's core business model was never really about the stock price. Tesla's core business model is all about creating full self-driving vehicles that customers love. Having access to a high stock price, being able to raise capital at a snap of their fingers is just a side effect. It's just a little bonus. It's not as if Tesla was doing everything it could to shoot its price up. It just happens to be a side effect of all the great things that they are doing to the automaker industry. He also raised his 2025 delivery estimate to 1.7 million from 1.3 million, quite bearish, I would say. But nevertheless, he has increased his price target, and he thinks Tesla is a perform rating. Next up, we've got Credit Suisse. They raised their target from $400 to $800 on the January 11th. That's a 2x of the price, and well, the target has pretty much been hit since then, because Tesla's already way over 800 right now. So let's see what Credit Suisse had to say. Fun fact, their price target 800 is actually the second highest on Wall Street at the time of the report. They maintained a neutral rating, but the key emphasis for the price target increase is the expansion of production capacity for the year of 2021, which will further ensure growth in volumes. So with expansion in Shanghai and new facilities in Texas and Berlin, we estimate Tesla will exit 2021 with installed capacity of 1.44 million units versus the current 840,000 currently. The added capacity underscores our forecast of 2021 deliveries of 853,000 versus the consensus of 791,000. Well, yeah, this does look like a more likely number. We all know how fast Tesla can build factories, so this we're gonna see some interesting numbers for 2021. So they pointed out some good lessons from 2020. It was clear that the market is paying Tesla to take the capital. So the company raised $12 billion in 2020, and even then saw no decline in its share price. So they issued out more shares back in 2020, and the stock just continued to climb. And that's something that no other automakers have. That's an advantage that no other automakers have. So clearly the market believes in Tesla, or at least the money shows it. And with all that money, they definitely can grow the production numbers. The second learning point was there was significant progress in margin because Tesla has been innovating, and so they managed to cut cost and basically increase their profits. And also Tesla has been setting more realistic expectations and have been meeting them more early this time. So kudos to them. And you gotta love how Elon Musk would try to sandbag his numbers a bit this time, and you're over-delivering. That would be a great direction moving forward. And that was Credit Suisse. So in summary, they believe that exponential increase in production volumes is gonna take the stock to the next level. That's it, price target has already been hit, and they are still neutral on the company. Next up, we got Bank of America. They upgraded their price target from 500 to 900, which is an 80% increase. Tesla has not hit 900 yet. At the time of this video, Tesla's highest all-time highs was $884. Let's see what Bank of America has to say. In their report, they say Tesla's high stock price begets even more equity funding, which begets even more growth. Basically kind of like a domino effect. So once again, Tesla stock is driven by growth afforded by valuation. So basically, higher stock price begets even higher stock price, which, well, it's kind of true because they have so much opportunity to raise capital at any point in time. Well, not, but even though they currently don't really have to anymore. The bank did say that the company may or may not be dominant in the long term, but that does not matter as long as it can keep funding outsized growth with almost no cost capital driving the capacity expansion. Well, the bank did warn that the risk of owning this stock includes Tesla's potential inability to continue raising low-cost capital to fund business ventures, and the inability to generate positive earnings or free cash flow. Quite an unlikely possibility so far. Tesla has been ramping up production. There's basically no doubt on the demand for EVs, and we're just at the start of this whole EV domination. Of course, assuming that they can't be profitable, then obviously we could expect a domino effect on the downside as well. Or let's say for any other reason, the whole market suddenly decides that Tesla is not worth holding. Then Tesla would not be able to issue more shares or raise more capital so easily anymore. Is that possible? Yes. Is that likely? Probably not. As long as the market continues to believe that EV will grow and that Tesla will continue to dominate the EVs, this scenario is quite unlikely to happen. So other risks includes a slower ramp in the demand, setbacks or lack of advancements, and fierce competition from incumbent car makers. Well, I'm not going to go too far into the competitors, but Tesla's full self-driving technologies and battery innovation are just years, if not decades, ahead of their competitors currently. So as much as I do wish to see some competition, it doesn't look like that's gonna be happening anytime soon. But interestingly, they have a high price target of $900, and that basis is because the stock price is rising, which begets even more stock price increase. Next up, we got the Deutsche Bank. How do you pronounce this? Let's see.
Deutsche Bank.
But not quite. So let's see what Deutsche Bank has to say. So Deutsche Bank analyst Emmanuel Rosner raised the price target, keeps a buy rating. Essentially, they see strong volume growth in 2021 for the US autos and an ongoing solid mix and pricing helped by easy companies, low inventories, and COVID-19 induced demand for comfort, privacy, and protection. Well, essentially, increased demand due to COVID and increased production capabilities. Also, the Democrat victory in the US Congress could result in demand upside from large federal spending on infrastructure and towards electrification. So basically, the political environment is also going to be supportive for Tesla's growth. Alright, at least we got a little more, a slightly more fair opinion here. So I'm looking forward to 890 soon. Next up, we got the Phillippe Houchois. I don't think I'm pronouncing that correctly. Alright, let me try this. Phillippe Houchois?
Phillippe Houchois.
Phillippe Houchois. Ooh, okay. So Phillippe Houchois raised their price from 650 up to 775. That's a 19% increase, and it has already been hit. Let's see what Phillippe Houchois has to say. Well, oh, I'm sorry, I think I got my facts a little bit wrong. So, Phillippe Houchois is the analyst, and he will represent Jefferies. Well, anyway, he said that while Tesla continues to lead the industry in terms of technology and business model, improved access to capital may turn Chinese NEV OEMs into more significant challenges than traditional legacy OEMs. So essentially, Tesla's innovating faster than everyone, and they can raise capital easily as well, putting them at a strong advantage ahead of everyone, which led them to this price increase as well. And lastly, we got Oppenheimer. Am I pronouncing that right?
Oppenheimer.
Alright, at least I got this one right. Oppenheimer. So they raised their price target for Tesla from 486 to 1036. That's the highest price target we've seen so far in this past few weeks. That's a 113% increase. And well, apparently we haven't hit that price target so far. All-time highs at 884. But I'm confident that eventually we're going to hit that. Probably within 2021. So let's see what Oppenheimer has to say. Alright. Based on Barron's, alright, let's take a look at a bit at the number, because Barron's said that Oppenheimer increased from 486 to 1036, while the street said it raised from 550 to 1036. I'm not sure which one is the correct one, but anyway, the rationale is cost reductions and simplifications in the group's manufacturing base, as well as expanded production runs linked to the start of operations in Berlin, Austin, Texas. All these factors is going to support Tesla shares, and all this would happen even after the 700% surge that raised the value of the group at more than 800 billion. Essentially, that means Tesla's innovations and streamlining of its efficiency in its production, on top of increasing production, is just going to keep pushing the stock price up. And this pushing of stock price up is just probably going to keep continuing for many years, even despite that huge exponential increase that we've already gotten last year. So that's Oppenheimer. Alright, so if we were to take the average of the new prices. I've just done a calculation. Apparently the average is actually at 844, which just so happens to be where the price currently is at the time of this video. Percentage increase wise, it's about a 70% increase. And it looks like so far about half of the price targets have been met, and the other half hasn't been met. Would we expect a 70% increase in the stock this year? I wouldn't be surprised if it did. I'll be happy if it went up even more, but you know, at least we do have more analysts that believes that that the stock price is going to continue going up. So one by one, everyone's increasing the price target. We've got a long decade in front of us, lots of room for Tesla to grow, and I'm just going to continue the dollar cost average. This is just my opinion. I'm not a financial advisor. Hope you guys enjoyed this video. Hit the like and subscribe button if you enjoyed it. See you next time.